welcome back to another episode of Beating Alpha. Today is an episode 106, and we have a very special guest on. His name is Austin Ye. He's a 25-year-old real estate investor from Toronto, Ontario. He started investing in real estate 2 years ago after he read the famous book Rich Dad Poor Dad, and came to the realization that he did not want to grind through the rat race for the rest of his life. Started off with only 40,000 Canadian dollars. Austin has successfully scaled to over 20 cash flowing rental properties, all while working a full-time finance job at Canada's largest bank. And you can become part of his journey and follow him on Instagram, Austin Ye 6. Of course, that is going to be in the comments down below. So make sure to do that. The websites, social medias, everything. Make sure to get in contact with Austin. But really appreciate you joining me today, Austin.
Thank you so much for having me on. I'm excited.
That's no problem. We're happy to connect. So listen, again, 25 years old still, right? That's updated.
Yeah, still 25.
Got it. So can you take us the time, 2 years ago when you were 23, you came across the book Rich Dad Poor Dad, and you kind of realized that you want to do this rat race and kind of just 9 to 5, and that's what it is, to life, and you discovered that there is more. So can you talk about that process? I mean, who handed you the book, and why have you realized that you need to invest in real estate in particular?
Yeah, no, absolutely. So, I mean, I'll backtrack a little bit and get to that point of how I arrived across the book. So essentially, ever since I was growing up, my family was just very frugal, right? Blue collar laborers working warehouse jobs. So your typical kind of minimum wage workers. And I learned the concept of frugality through them, right? So as I was going through school, I was like, I want to work a career where I make a lot of money, like a dentist or a doctor. So that's what I was fixated on. And going into high school, I didn't like any of the sciences, but I took my first business course and I fell absolutely in love with it. And also, business is much easier than the sciences. So I jumped in there, did fairly well, and went into university and specialized into business. And from there, I worked my first professional internship. And I was like, I can't do this. Maybe it's just this particular job. I was working in audit at one of the big four audit companies. And I was like, I don't really enjoy what I'm doing here. So let me try another job. So I worked another internship, and that was at Deloitte for consulting. Didn't enjoy that. So I tried another internship, and that was the Hydro One, so a utility provider here in Ontario and Canada. And I didn't like that job. I was working in strategy and business. And I just thought to myself, man, like, is it just me? Like, is it something like I'm just trying to find out what career path I want to go down in business? So then I came across my full-time job. It's at the Royal Bank of Canada, so the largest bank in Canada. And when I started that job, I was like, I can't work this full-time rat race for the rest of my life. It's not the particular jobs that were upsetting to me. It's more so the concept of office politics. You need to kiss up to climb the corporate ladder. You know, the entire rat race, like all of the politics involved with it, waking up early, commuting down for an hour. And I was just getting super fed up. And during that time, I was trying to trade stocks, but I lost money while trading because I'm a very emotional trader, I guess. And, I do the exact opposite of whatever Warren Buffett tells me. And I decided, I was just talking to a buddy and I was telling him, look, I'm looking to invest. I don't know what to invest in, what asset class. I need to just buckle down and work on, I guess, building my skill set in one of them. And that's when he recommended me to read the book, Rich Dad, Poor Dad. He was my three, and he had one investment property. And for me, that was phenomenal. So I picked up that book. I read through it, and man, it was a huge mindset shift. I can't say the technicals in that book, like you don't learn how to invest in that book particularly, but your mindset entirely shifts as to understand what are the differences between assets and liabilities. Assets being things that put money in your pocket every single month. Liabilities being anything that takes money out of your pocket every single month. And I was just thinking, I'm going to invest in enough assets to generate enough income so then I can retire. And that pretty much got me kickstarted on my journey to buy my first investment property.
Got it. Okay, so that's quite a journey, so far. I mean, from working 9 to 5, trying to trade stocks. You did the day trading thing, right?
Yeah, day trading, swing trading. Lord knows what I do. I don't even know what I was trying to do. I was just trying to make some money.
Yeah, well, it makes sense. So, like, what other options have you looked at? Because, I mean, in this day and age, there's a lot of different options. People talking about, Amazon, like drop shipping and, doing some sort of an internet type of business. So, what other options have you looked before you kind of decided I need to get involved with real estate?
Yeah, really, it was just between really equities, dividend paying stocks. So that falls under equities or real estate. Those are the really two biggest options that I was looking at because those are the most, I guess, publicly invested asset classes, right? With stuff like drop shipping, so on and so forth, I considered that more of a business.
Mhm.
Real estate has eventually evolved into a business for me, but when I got into it, I just thought of it solely kind of as an investment vehicle. But yeah, I mean, the reasons why I liked real estate more than stocks, for me particularly, one of them, obviously a lot of people talk about it, is leverage, right? So
Mhm.
you're not going to be able to leverage such cheap debt in the stock market. The interest rates on margin trading are much higher than the interest rates on buying a hard tangible asset, right? So in Ontario and Canada right now, my latest mortgage was 1.7% on a 30-year amortization. You have to
Yeah.
earn greater than a 1.7% return. Just greater than that, which is super easy for me to collect the spread on my money. And another big thing is that stocks, you can't really control what goes on in the stocks, right? For example, if Elon Musk tweets something stupid, then you're going to see Tesla's stock price plummet a bit. And we've seen that before. But instead, real estate, the asset class is pretty sticky, right? And the big thing is that if property prices drop, I could care less if they drop because I'm cash flowing, right? So as long as I can hold on to this asset for the long term, the fluctuations in property prices doesn't matter to me. And of course, like the income is the very appealing part for me in real estate, and being able to control the tenants I've been put in there, being able to control how much I can lift the value of the property up with. I'm a control freak, so I gravitated towards the real estate asset class.
Yeah, it makes sense, definitely. And when you talk about, again, it sounds like you're a long-term investor at the same time. So, like, one of the disadvantages, maybe for people who are listening, when you invest in real estate, that it's not liquid. Like, you cannot take the equity, you cannot take the money out as in a stock market, just like today or tomorrow. So you still have to, hold it in the house and like in equities, and until you sell it, and it goes through the entire process. But
Exactly.
again, your personal, kind of educational part, I would love to discuss that because I'm sure you didn't end up with the Rich Dad Poor Dad, the only single book, and it went from there. Can you talk about like what type of resources have you consumed to make sure that you're like well educated with real estate investing?
Yeah, absolutely. So what's hilarious actually, when I jumped in my first property, the resources I used to get in my first property was not that much. It was Rich Dad Poor Dad, which again we said that from a technical point of view, there's not much you can pull out of it. And maybe it was one or two YouTube videos, and I'm like, all right, let me just buy my first property. And that was
Nice.
my first property was a complete mess. So I can tell you the avenues that I
Sure,
learned.
sure.
The most I guess costly avenue that I learned, but it resonated with me the most. The lessons were making my own mistakes to the first property, right? So I worked with the first real estate agent I ever met or spoke to, which obviously you want to work with an investor oriented agent, real estate investors who help real estate agents who help other investors buy properties. So this agent has never worked with an investor. Contractor, I work with the first contractor I ever spoke to as well. And here in Ontario, the contracting industry is notorious for kind of screwing people over, taking a high deposit, running away from the job, or extending timelines. All of those kind of happened to me. I underestimated my renovation cost. I didn't understand any of the materials or any of that goes into construction. Property manager, I used the first property management company, which I ended up firing. So these are mistakes I learned myself. And obviously, by making these mistakes, I told myself I'm never going to do it again. And there were hard truths, right? So that was one avenue that I'll learn going through my first property. But in order to better prepare yourself, I encourage everyone to do a couple things. First thing is that find a local meetup or community in that area that you want to invest in. So it's super easy for me. Like if I'm investing in Windsor, Ontario, even though I'm from Toronto, Ontario. And what I do is I go on Facebook, I search Windsor real estate, and then there's a bunch of little community or meetup groups you join. You connect with other local investors, and you educate yourself on the local market. Second thing I would do is that I'd watch YouTube videos. For us, like millennials, it's very easy to access information, right? If there's a problem that you're running across, 99% chance is probably someone who made a YouTube video on it.
Yeah.
So real estate, if you're a visual learner, definitely get on YouTube. Find real estate investors, probably local, at least to your country, who have YouTube channels, because I'm pretty sure every country they'll have like a YouTube entrepreneur. And if there's not, you should start doing it, because that's a great way to brand yourself, right? And also read books. So the big book that I recommend, it's really more North American based, but I think it should apply to any country really, is it's the book on investing in rental properties, and it's written by Brandon Turner of Bigger Pockets. So Bigger Pockets is a huge investing community out here in North America. But yeah, as long as you read books, you also, of course, listen to podcasts like Beating Alpha. That's a great way to pick up on information from other experienced real estate investors. I was looking, you have some crazy guests over here. So you can extract information from podcasts, making your own mistakes, from reading books, like such as the one that I suggested, YouTube videos, and obviously you can work for free for someone if you find a mentor. I at the beginning couldn't trade any money for time because I didn't have much money. All my money was tied in kind of my first property, and I wanted to get mentorship. So I went to someone who had 60 properties, and I told him I'll work for you completely for free while working at RBC, my full-time job. So pretty much every afternoon, I would communicate with him. I would do work for him for free. Every weekend, I would literally stay over his house. So I barely saw my girlfriend. And I did that for 3 or 4 months straight, every weekend going over there. There was even a day, I remember a weekday, I was staying up until 4 a.m. to help him do his taxes. And then I went to work in the next day at 7 a.m., right? So it's all about hustling and grinding. If you don't have the money to pay for a coach, you got to give them your time. But a long-winded answer, but there are so many different ways to learn. People kind of struggle to figure out like which way to go, but best way that I could recommend is, for me personally, books help the most, because again, if you go to school, we're kind of taught to learn from the textbook, from beginning, middle, and then building up the concepts from there. You're probably going to get a similar situation when reading books, where they give you the fundamentals and build up on that.
Got it. Oh yeah, definitely. There's so many different free kind of resources available, free or either, like $10, like a book that you mentioned, Brandon Turner book. I'm sure it's dear cheap, so like so many different sources are available for people to consume right now and educate themselves. But I love the fact that you kind of, you read the Rich Dad Poor Dad, you watched a couple of videos, and you was like, I'm ready to rock and roll and kind of invest into, into real estate, which is awesome, because it's all about taking action at the end of the day, right? So can you talk about your personal deals? Because you mentioned you're investing in Windsor, Canada. Like, I'm not from there. I don't have a clue. I mean, why have you decided to invest in Windsor instead of Toronto? Is that a big like driving distance for you?
Yeah. So I'll actually walk you through that. So when I started investing after reading Rich Dad Poor Dad, I had about $40,000 Canadian saved. Average home price in Toronto, at least now, it's almost $1 million. So let's be real, $40,000 cannot buy anything in Toronto, not even a parking spot. Parking spots go for $100,000. So I knew that this was not feasible to stay within my area. And a big thing is that if I was to sit around and just save my money until I can afford a down payment in Toronto, I wouldn't be able to break into real estate until at least 5 years, right? Saving that amount of down payment would be insane. So what I did instead was I looked at smaller cities. The big thing is that when you're investing in big cities, you're investing for appreciation because they're cash flow negative. For those who don't know what cash flow negative is, essentially on a high level, if your rents don't cover all of your expenses, including your property taxes, insurance, including your utilities, your mortgage payment, and even like repairs, right? I know some people don't like to allocate repairs. I allocate repairs every single month, regardless if they happen or not, just in case, because I know eventually will happen.
So
and I make sure it's cash. Sorry.
And how big of a percent is that from a gross?
Oh yeah. So for me, for repairs and vacancy, I allocate 10% in total. So you could say 5 each. But yeah, so I allocate about 10% of my rental income to vacancy and repairs every single month, because it might not happen one month, but it would probably end up happening maybe a year, 2 years, 3 years down, and you need to make sure you have the money for that. After all of that, these large metropolitan cities, they're not cash flowing. They're appreciation plays. So what I did was I looked for markets that I could afford with $40,000. So I like to tell, when people ask me what market to invest in, it's usually younger people around 20 to 27, right? So they don't have too much money saved. And I asked them, I was like, okay, so how much money do you have saved? They tell me, it's like, how much are you willing to invest out of that? If they say all of it, most people, they usually say 50 or 60 grand. And then I asked them how much are they making from their full-time job, because that's going to determine how much they can qualify for in terms of a mortgage, right? If they're making in Ontario, if they're making less than 100K, forget about even investing in Toronto. You're not going to be able to hold a mortgage yourself. So those are the two things that are going to determine what market you invest in. One, how much money you have. Two, what your mortgage is, because if you're limited on both, don't even talk to me about those big cities, because you don't have the money or the financials to support that. For me, I knew what my criteria was. 40K, could hold about 300K in the mortgage. So I had to drive 4 hours out. The only city I could afford was Windsor, Ontario, right? Relatively blue collar city, a lot of factory workers. So it is growing in terms of getting new industries and employers involved in there. But for me, my primary focus was cash flow. And in every city, even cities that are not as desirable, there are pockets of areas of good locations within that city. So for example, where I live in Toronto, there's an area called Jane and Finch. Everyone will generalize Toronto as a great market, but there's an area called Jane and Finch, which is terrible area, and no one would want to invest there. Not many people, right? So you can't make generalizations. So people would generalize the city of Windsor as being blue collar. Yeah, but there are pockets of areas in that city that are always going to be desirable to locals. So those are the areas that I invest in, because regardless if there's a recession or people leaving, those areas to the locals will always still be desirable versus like some of the worst pockets of that neighborhood. But yeah, really, I just chose the market based on my qualifications and based on knowing that I want cash flow. And I kind of took action, right? I didn't care if it was 4 hours away, because a big thing you're going to realize in real estate investing and in business is you're not doing everything yourself, right? Big example that I like to give is that the CEO of Microsoft, he's not going down to Canada or to the US to help these analysts do their day-to-day work. He's managing the big operations, right? And that's what you're eventually going to be when you invest in real estate. You manage the big operations. You hire the small things out to property managers, to contractors. You don't want to do those hands-on stuff, because that's not where your time is most valued. Your time is valued in closing deals, finding undervalued properties, raising capital. So really that 4 hour distance allowed me to force myself to build a power team out there in Windsor.
Got it. So can we go kind of the deal criteria that you're actually looking for to buy? Like what type of properties we're talking about?
Yeah. So the properties I own range from single family student rentals down to small multis, so four plexes around there. Criteria is a bit different for each one. So for single families, what I like to do is my priority and strategy is buying an undervalued property, renovating it, then refinancing any of the money I put into the property. So I pull that money out and I can buy another property with that money, which is how I was able to scale. So my main criteria, number one, is leaving a minimum amount of money in the property. So if I buy the property for 100,000, I put in 20,000 in renovations, for example, I want the property value to be like 170, 180,000, right? So I can refinance all my money out of the deal, take that and buy another property. So that's criteria number one, is making sure I have minimum capital invested after refinancing. Criteria number two is cash flow criterias, right? So for my single family homes in Windsor, again, it's market to market. It's a bit different. Actually, you know what? I'll state it on cash return, because that's a more universal metric. So guys, if you don't know what cash on cash return is, it's essentially what's your yearly cash flow. So what's my cash flow I get every single year, right? Divided by how much money I put into the property. So in other words, how much for every dollar I invest in this property, how much money is this property paying me back, right? So my cash on cash return target in Windsor, Ontario, it's about 25 to 30%. So for every dollar I invest, I want 30 cents in return back, right? That's what I'm kind of looking at. And bigger multifamilies, I'm okay with leaving obviously a little bit more money on the table. But again, from a cash on cash return perspective, I'd like to see at least 25 or 30%. But yeah, that's kind of what I've been going off of. Again, like for me, I'm a cash flow investor, so equity pay down, it's nice. I'm always going to get it regardless. Appreciation, I honestly could care less about appreciation. It's a nice cherry on top for me. But for me, again, like for me to retire, if you guys are investing in real estate to retire, what you're going to find is cash flow matters much more than equity, right? How many people in Toronto do I know that have $1 million in equity in their house, but they can't make that equity work for them? They can't use that equity to generate them a dime in revenue, right? Because they're not savvy investors. For me, if you give me $1 million in equity, I'd retire myself in a year and a half, right? I'd deploy it all. Like again, let's do the cash on cash return formula. I deploy $1 million, 30% of that becomes revenue. So I would be generating myself 300K in yearly revenue perpetually, right? By buying investment properties with that. So yeah, I've always been a cash flow targeted investors, which is why you'll hear me talk about the cash on cash return.
Yeah, that is awesome. That is really cool. So yeah, that's the difference. That's the main difference investing in Windsor rather than Toronto is for cash flow, not appreciation.
Exactly.
So again, talking about the current deals, I mean, what do you have in the pipeline and what you're looking for at this current moment? Is it the single family or so all multifamily?
Yeah, no, I do everything, right? With single families, I prefer it to be student rentals because it's higher yield here in Canada. Because with student rentals, we rent it by the bedroom. So each bedroom would rent it out for around 600 to 650 bucks. And you're buying the house for like 300K, right? So student rentals, it's all about maximizing the amount of bedrooms in the house. More bedrooms you have, more students you can fit in, the higher your yield or your rental income. So when single families, again, student rentals because high cash flow, high yield. With multifamilies, I like to look for around fourplexes. Ideally, I want to operate within the 4 to 6 range. And that being, this is more Canadian specific as well, is that once you go above 6 units, you need to go commercial financing 30% down. I just want to take advantage of putting only 20% down here in Canada. So the maximum I'm buying up to 6 units. And again, that's what I feel comfortable in. I also know my limitations, right? I'm 4 hours away. I'm working a full-time job. I don't think I can buy like a 10 unit and make it work out as quickly as I would like to, just because I'm limited on resources and time, right? So also like I hear a lot of people wanting to buy the big multifamilies, and realistically, if you're working a 9 to 5 like me, that requires you to work in a corporate environment and stuff. Those properties, like you're gonna have a little less time to allocate because a lot of those properties you're going to have tenant turnover, then renovate each unit. And here in Ontario, it's almost impossible to turn over tenants. Like the rules are so in favor to the tenants. So when I buy multifamilies, I like to have a couple of units vacant. So if it's a fourplex, at least 1 or 2 of the units vacant. And I try to get the other 2 units vacant by offering them cash incentives. So I'll go up to them and be like, hey, do you guys want $4,000 now? I just signed this paper, and this is basic papers agreeing that you leave in 3 months. Right. And I'll give you $4,000. They sign it and I give them $4,000 in cash right in front of them. So I show them the money right in front of them because it's a psychological game. Right. But yeah, like that's kind of what I've been looking at. Really student rentals up to 4 or 5 plexes.
Got it. Okay. So again, 4 hours away from where you are, you're in Toronto and you're investing in Windsor. So any tips for somebody who's watching, how do you hire the right property manager to make sure that, that person is going to take care of the property as well?
Yeah, no, absolutely. So in terms of investing long distance, the biggest worry people get is that I don't want to drive down there if it comes down to it. Right. Well, really, it's all about hiring the right people. Let's say you run your own business and you have an employee, right? And your employee is like your best friend, right? And he's a killer employee, like great. And he comes to you and says, yo, I have another buddy that you might want to hire. He's just as good as me. You're going to take his word for it because it's coming from a trusted person. And obviously you trust their word. So you hire that other person, right? And that's how it's like investing long distance. You got to take the word of experienced investor. So this is kind of the order I would like to say it is that when you're looking to invest long distance in a particular area, find a local investor meetup group first. That's your number one. If you can't do that, I would try to find another area to invest in, because if you cannot invest with locals, you have no boots on the ground there, and you need some boots on the ground. So for me, I was able to find it on Facebook, Windsor, and meetup.com, which is more American, Canadian. But if there is one in another country, there's probably something similar to a meetup.com. You can find all of the groups and organizations and community. So I went on meetup.com, I searched Windsor real estate, joined all of those local communities, right? Now you're in touch with all of the investors. Now you post on the group, you engage with them. Hey guys, I'm a relatively new investor. I live 4 hours off. Do you have time to jump on a Zoom call? Jump on a Zoom call with them and then inquire, ask them like, what are they seeing in the real estate market? Ask them which property management are they using, right? Ask them what contractors are they using, any recommendations, any advice. Connect with all of these investors, right? And when you connect with these investors, now you have like a list of different contractors, different property managers. Now interview them, call these property managers, call these contractors. I'd ask the contractors, do you know how to use WhatsApp or Facebook Messenger? If they say no, I'm not working with them, because how are they going to send me updates of videos and photos? Because I'm long distance, I don't want to be down back and forth. So you guys need to know how to use technology, right? That's rule number one. Rule number two is, have you ever worked with a long distance investor, especially contractors? Property managers, most definitely, they probably have. But contractors in specific, if they haven't worked with long distance investors, I'm not going to be your guinea pig, so forget it, right? Like, I want people with experience, and the only way you leverage these people is by leveraging your connection of the other investors. Because again, like going back to that analogy, when you hire someone, a recommendation from someone that you know is well trusted goes a long way. You're probably going to hire that person, right? Because it's a trusted recommendation. Similar thing in real estate. If you trust an investor, build relationships, see experienced investors operate, and they refer you to someone, you take that with more weight because they are being used in their business. So why can't they be being used in your business? But big thing is, make sure that at least they've operated with long distance investors, right? Because you don't want to be the guinea pig and go through a nightmare like I did with my contractor.
Got it. Well, that's a super great tip, and I really appreciate you sharing that. I think it's going to bring a tremendous value for people who are looking to invest long distance. Question that I have for you again, coming back to that long distance investing, part. How were you able to source these type of deals? Was it through brokers or by using any other creative strategies?
Yeah, absolutely. So the deal hunting is a question I get a lot, because it's funny. Being out in Toronto, I find that sometimes I get more deals than the people local on that market, right? So there are a couple of things to that. First thing I want to get across is branding. You need to definitely brand yourself. So for me, how we actually connected was through social media, right? So I brand myself quite heavily out in social media, saying that I invest in Windsor. Here's my project. Here's another project. I'm working with investors. I'm always looking to buy deals, right? So automatically I'm top of mind for a lot of people, even people I've never spoken to in my entire life. So I knew someone who reached out to me. Well, actually, I didn't even know them. They just reached out to me and they're just like, hey, Austin, you're looking to buy properties in Windsor? I said, yes, I am. And they said that, yeah, my uncle's actually looking to sell. Boom, we got an off-market deal just like that, right? And that was just through branding and building a credibility for yourself. And a lot of people will say, again, like, I don't have any properties, so how am I going to brand? That's totally fine. When I started branding, I had 0 properties. I just documented my journey. Like, hey, I'm at this event today. I'm at this mastermind. I just spent $5,000 on coaching. I just did this. I just did that, right? People want to follow the journey and follow the hustle. One thing that you have that a lot of people don't have is the journey, because you're starting from square one and recording and documenting everything. That's rule number one, branding, and you'll have people reach out to you because you'll be top of mind. Another thing that I do is that in terms of the off-market portion, so in Canada, we have a website called Kijiji. US, it's Craigslist. I don't know if there's in different countries like what it is, but it's basically like a marketplace where people just post stuff online. And I just search for sale by owner. I check it 2 or 3 times a day, right? A lot of the times you'll see a lot of MLS or public listings, but there are sometimes in between there you would see an actual true authentic for sale by owner, and those are a couple of deals that I snipe up. I want to say I got 3 or 4 deals through that method. And another big thing I do, and this is something that people don't do enough, I actually don't know too many people who do this, and sometimes I'm guilty of even slacking on it, is that you need to make phone calls to anyone who touches, sees, and smells real estate. And what I mean by that is that in Windsor, so if I go on Google, I will search Windsor pest control. I will call each one of those pest control companies and say, hey, how's it going? I'm an investor out in Toronto. I have X amount of properties down at Windsor. Yeah, I know some of them. I like to kind of make it seem like I'm interested in their business first, just to create a relationship. Yeah, I'm interested in your pest services. Can I hear more about it? Blah, 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 blah. At the end of the phone call, drop in, hey, by the way, I'm always looking to buy properties. I know sometimes you probably run across properties with a lot of pest issues. If you think the owner is even considering to sell privately, I will buy a house in any condition whatsoever in cash. So if you can pass on my contact information or pass on their contact information to me, if I end up closing on that deal, I'm going to give you $1,000, right? I do that with 5 pest control companies out in Windsor. I do that with every property management. Property management, I'll be like, hey, if you have any disgruntled landlords who are tired of dealing with their shitty tenants or whatever, like just I'll step in, right? And just give the contact information to the interested seller. And if we get a private deal done, I'll swing you $1,000. I do that with landscaping, right? Some landscaping companies might be like, oh, this person doesn't take care of their grass, there's beer bottles, this and that. Here's the address, here's the owner's address, contact them. If I close that, I'll give you $1,000. Who else? And home inspectors probably see deals that fall through. Like, you know how someone buys a house, they walk through it, and the home inspector's like, this is wrong with it. The buyer might pull us, like, I don't want it. I don't want to deal with these problems. Well, the home inspector knows that deal fell through. Now he can pass that lead on to you, right? But yeah, just again, long story short, contact anyone who touches, sees, and smells real estate on a daily basis. Because if you do that, if you make one phone call a day, you're making 365 phone calls a year. You have 365 people looking out for deals for you. You are going to get at least 1 or 2 deals during that year. But it's all a numbers and hustle game, right?
Exactly. That is really cool. Like I love the fact that you just shared all these creative strategies, talking with these different people, which is awesome. It's a really great strategy and a great point, and I think it will be really valuable for people who are gonna take action, of course, onto that. And of course,
exactly. And the perfect thing is that even it doesn't matter where you're located, right? It's just phone calls is all it is.
Yeah. Oh, eventually it's going to happen. I mean, if you're doing that consistently, like you said, 365 days a year, like you're going to find something,
Exactly.
Find something.
Exactly.
Again, I know it's going to be kind of a little bit jumping from the topic, and of course we're going to come back in a second, but I just want to ask, because I know there's a lot of people that, especially during these times, they're thinking like maybe finding the money for these deals, at least for the down payment, could be an issue. So can you talk about your process of how did you came up with this 40K in savings? Because a lot of people, they know like, oh, I do need to be frugal, but that's all it is. Like, what type of strategies have you used to make sure that you can come up and save this amount of money?
Yeah, I mean, I'll be honest with you. Mine's is pretty boring. It does revolve a lot about frugality. So I mean, it's hard for people to replicate because I've been doing this since I was young. I was telling you that my parents are very frugal in nature. So by a byproduct of that, every Christmas money, Chinese New Year money, every birthday money, it was taken aside and put in a bank account, and I never got the credit card or the debit card until high school. So I had 8 years of saving, or not until high school, until university. So I had years and years of saving, and throughout high school, I worked summer jobs, like literally every summer, full time, 40 hours a week. Every summer from grade 9 to grade 12, I worked a full-time job during summers. And I saved that way. And then university, I got a scholarship, internship. I saved almost everything I can, right? So how, like, if I was to answer the question, like, how do you go about saving money to get into real estate investing? I want to present a couple of, I guess, challenges to that. Oh, not challenges, a couple of rebuttals to that, right? The first thing is that, yeah, I mean, the slowest way, but is to go to the frugality route, but that's probably the most essential way, because when you go in real estate, you're gonna get used to feeling like you have money and going broke because you're always taking money, putting it out, refinancing, taking money, putting it out. So like it always goes, your bank account goes up and down. So you got to get used to being frugal. Frugality is number one, because I can tell you right now, earning more money, that would be number two, but earning more money is significantly more harder than saving money. Okay. Earning, like, think about getting a promotion at your job just to get a 5 or 6 or 7% raise. It takes 2 or 3 years of hustling and grinding just to earn 6 or 7%. Well, I would like to say, if you just save 6 to 7% more a year, if you just work on saving, that's more controllable, and that's much more easier than trying to get a raise at a job, right? So first thing is saving more, because saving is the easiest thing you can do immediately to boost your bottom line, right? Then earning more. So taking on side hustles, like doing Uber Eats, working part-time at another company, is just really grinding it out and getting that down payment and that savings there, right? Another thing is lines of credit. Okay, so here's a tip is that, and this is not advice, right? This is just kind of what I've seen and kind of what I've done myself as well, because it is high risk, is that here in Canada, we can get unsecured lines of credit, okay? I'm pretty sure it's the same around the world. You can get an unsecured line of credit. Essentially, I get a line of credit with every single bank, unsecured line of credit. Yes, it does temporarily blip your credit score. but ultimately, like, your credit score is really fickle anyways. It goes ups and downs. So if your credit score is consistently high and you apply to all these lines of credit, short-term blip, but it's for long-term gain, right? So all of these lines of credit, you kind of build it up. So now, even if you have money for down payment and you don't have money for renos, you can fund those renos through your lines of credit, right? And then you can refinance that property after you build value in it through renovations and pay down all your lines of credits. And I've done this before, right? I've had money for the down payment, $0 for renovations. I pulled everything from unsecured high interest lines of credit, right? But again, this is because I'm more experienced, right? And then I refinanced the property, paid all of my lines of credit down, took about my down payment. So I'm in for $0, right? And I made this deal happen even though I didn't have enough money because I borrowed money from the bank technically. So lines of credit is another alternative. But a big thing I do want to put out there is that if you have half of the money and your friend or family has another half of the money, maybe try to partner with them, right? A lot of people are trying to focus on saving everything themselves, and they're getting worried because they're seeing real estate prices go up, 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 right? And they're thinking to themselves, how am I ever going to go in? Well, if you partner with someone, now you need half of the savings, right? Now you need, technically you can put in half of the effort. You can spend a bit more, you can save a bit less, although I don't recommend it. And because now you're splitting the initial capital with 2 people, you can even go as far as partnering with 3 people who are interested in real estate with you, right? But you don't feel the need that you need to do it with yourself. If there's an opportunity that makes sense to partner with someone, right, to go half with someone, then definitely explore down that route because it can get you in the market quicker. But yeah, if you want to do it yourself, really, you got to just work on saving and earning more, in my opinion.
It all comes down to that frugality, because we as millennials, we sometimes, chase those shiny objects, whatever that might be, new phone coming up, new computer, or there's something brand new thing, and I have to have it. So
Yeah.
it's building that kind of habit of being frugal. So
it's not second nature for a lot of people.
Say that again.
It's not second nature for a lot of people. It's tough. Yeah,
exactly. Well, it takes some time and struggles to build that, as everything in life that is good. Everything takes time. But like, I wanted to ask you again, because you mentioned about you have some of the multifamily deals that are kind of student tenants, and I'm sure maybe you have family, single people. So can you talk about how do you go about with your tenant screening process?
Yeah, I mean, yeah, for me, again, like, what I like to do as kind of, I guess, a business owner at this point, because I raise capital and invest it, is that I allocate things to the experts, right? The people that I trust. So I spend more time betting out the property manager and seeing if they're going to put a focus on me and my portfolio, what they're already managing. So I spend time betting out the property manager, and I let the property manager do the day-to-day betting of the different tenants, right? And then they give me final say. So that's kind of how I'm operating it, by the way. So I'm not looking at every application because, again, that is a $20 an hour job. You want to focus on making $1,000 per hour revenue driving income streams, right? Which is raising capital, finding good deals. So for me, the final say, the things that I always like to see is how much money did I have saved in the bank account. This is important now during COVID. Before, I was a little bit more lenient, but during COVID, the issue is that if you go through another shutdown here in Ontario, and a lot of these people are not working again, right, which we are kind of getting to that point in here in Ontario, is that I need to make sure they have savings so they can still pay rent, or at least pay a portion of rent, right? And they totally decide not to stop paying it all. So savings matters a lot. Credit score. Again, like, I kind of like to see the credit history as well. I'm okay with a lower credit score if it makes sense. If maybe 4 years ago or 5 years ago they went bankrupt, but ever since then their credit has been absolutely perfect. I can see through those things, right? But just analyzing their credit score and digging deeper into seeing why it's that particular score. Did they do anything recent to kind of screw it up? Because if so, that gives red flags. Another thing is cosigner. I like to always get a cosigner whenever possible. And the reason being is because if you can't give me a cosigner, what are you telling me? It's a red flag, right? If your own parents or your family or your friends or no one's going to cosign for you within reason, right? Then it screams like, your own inner circle is not trusting you for whatever reason to pay your rent on time. So why am I going to trust you to pay me rent on time, right? And the last thing that I like to do as well, and I put this out on the table because you can't necessarily ask your tenants for this, but when I have multiple walkthroughs, I will let them know that, hey, I have multiple interested tenants who are going to be applying. One thing that will decide on the factor is that who is going to put more money down. Like, and you know how people do first and last, but I had tenants who gave me 4 months, right? And that is a huge hedge during COVID, right? Because if the tenants just stop paying, at least you've collected 4 months rent, right? Up front. So it is a huge hedge, and it's comforting to know, because it also tells me that they're going to stay here long-term, take care of the place. So it's all of these small things, but really the day-to-day screening up tenants, I don't deal with that again, because it's really not worth my time, right? Like I hired that to an expert.
Yeah, yeah. Again, some more creative strategies, which is awesome. I mean, I love the fact you're coming up, like, you're a pretty creative guy, and you're coming up. I'm sure you learn, a lot. Again, books, meetups, like all the different, like YouTube sources and podcasts or whatever. But like I love the fact that you're going about being creative and like finding what it's really difficult sometimes to onboard and collect the rent payments during this time. So that is really cool. So you talked about the raising capital part. So what are you going to be raising capital for? Can you talk about that process?
Yeah, absolutely. Yeah. So this actually will kind of, I guess, answer that question that you had earlier as well. What if you can't save 40K, 50K or whatever, buy your first property? Another alternative, it's a bit harder when you're starting off, but what I'm doing now is I'm raising capital. So essentially what I mean by that is that kind of I've been documenting my entire journey on social media. I've been hosting events out here in Toronto, like little meetups for real estate investors, just to chat, meet with each other. And by doing all of that, I was able to build credibility for myself in my local market, right? It's all about using that credibility to see how you can leverage that to your business. So ultimately, by doing all of this branding, people started to trust me. And a lot of people are similar in my situation, where they want to invest, when I was starting off, where they wanted to invest in real estate, but they don't know too much about it. But with these people, they have a higher risk tolerant. They have a lower risk tolerance. So they want to invest with someone who's experienced, right? So what the proposition I do is that they essentially provide me 100% of the capital. So I'm putting no money in these deals now, right? So if the project for renovations down payment are 100,000, they'll give me $100,000 in cash, right? They will hold the mortgage. So I'm not even using my own borrowing capacity anymore, right? And in exchange, what I do is that I do all of the work to the property. So I source the off-market undervalued deal, I renovate it, and I refinance the money. So let's say they have $100,000 in the property, right? They gave it to me, and we deployed 100,000. If I refinance out 80,000 in 4 or 5 months, right after renovating it and bringing value to the house, I will give them all of that $80,000 back. So now they're only 20,000 in the property, right? But from that point on, now we're splitting the asset 50-50, right? So that's how I've been going about structuring my joint venture partners. And essentially what happens is at the end of the term, so it's a minimum 5-year term, but let's say in 5 years we want to sell the property. So remember how they were in 20,000. So they put in 100, they got 80 back on refinance. It's still in 20,000. At the end of the 5-year term, that $20,000, it goes back to their pocket, right? So upon sale, they get all 20,000 back, and then we split profits 50-50. But then the case might happen is what if there's no profits? What if we just pull out 20,000 and there's no more money after that? They get all 20,000 back and I don't get paid. Let's say in 5 years the property value dips. Obviously, what you would do, you would just hold the rental property until, like, obviously it starts picking up again. But let's say worst case scenario, property values dip and it's never going to recover. Like some Armageddon type of stuff happens, right? When they sell it, let's say they lose 50K. Well, I'm losing 25K with them. I'm putting in 25K and they're losing 25K, right? The only contingency, not the only contingency, the only big thing is that they have to put the money up front and hold the mortgage, right? But we put that all in a side contract, obviously developed by a lawyer. So you spend a couple $1,000s drafting that contract up. But yeah, that's how I've been going about it. That's how I've been able to scale with really none of my own money. It's just I'm raising capital now and I'm just providing investors comfort. Look, I'm going to earn you a return on your money. After you break even, we're going to split everything 50-50.
Got it. Another creative strategy for you guys and girls to use. So, are you planning to invest in other cities beside the Windsor as well? Are you looking at something else?
Yeah, I mean, I'm kind of glancing at other markets. For me, the reason why I like Windsor is because it does definitely take a lot of your time to build the systems and teams and reputation in a particular market, right? And I feel like I've only been investing for 2 years. It seems like it's been quite a long time, but it's only been 2 years, and I think I haven't really generated the full fruits of my labor, because I want to say the first year is spending perfecting all of the systems and getting a couple of investment properties. And then really now I want to, since I kind of perfected the systems, I think I'm still in the shoes to scale more. When you have a market expertise, the big thing as well is you have a huge competitive advantage. And to build that market expertise in a new market, it takes a lot of time. But that being said, I have been exploring other markets as well, because Windsor prices have risen by 30% year over year since I started investing. So yeah, I mean, I'm looking at other smaller markets that have maybe a larger population, but they're kind of in the outskirts away from Toronto because they cash flow much higher in those markets. But whatever market you're whatever city you're living in, even if it's a big city where house prices are unaffordable, I can almost guarantee, right, if you do like some research, you're gonna find there's another city within a 4 to 5 hour drive that's much more affordable and cheaper that you can invest into and cash flow, right? Those are the kind of markets I've been exploring. But until then, I'm just kind of sticking around Windsor because I have all my teams down there.
Okay, got it. Makes sense. So you're still going to invest in the Windsor for now. So again, a couple last questions that I have. First question is, I mean, looking at currently what you have in the pipeline, like how many more deals are you planning to close on this year?
Yeah, I'm actually trying to slow down a bit more because I'm working full time, right? So I know what my capacity is. I don't want to overtake or overstep my boundaries and, the conflict of interest with other investors because I'm working on too many projects while working full time. I'm just trying to get 1 or 2 more projects maximum by the end of this year. And for next year, probably 2 properties a month. That's a scalable pace. But I mean, once I transition over into real estate full time, and some people might ask when that will be. For me, if COVID didn't happen, I'd probably be in it full time now. But since that is there, I like to stay safe, right? So I like to have that backup security of income. So I'm still there temporarily. But yeah, I mean, sorry, I've circled around so much. I totally forgot what was the question.
Yeah, if you're planning to close on more
Oh
deals
yeah,
in
yeah.
this
So
year, yeah.
long story short, yeah, I mean, a maximum 1 or 2 boundaries the next year, probably like
Mhm.
2 to 3 a month until I quit my job.
Got it. Awesome.
Then we're looking at.
Can you hear me here?
Yeah, I can hear you.
Yeah, sorry, just connection here disappeared for a second. But yeah, we got that answer. Okay, so the last kind of question that I have for you, and it's going to be a little bit esoteric one, but and I don't know if I'm, I think I'm a little bit too early in a cycle in a personal business to ask you that type of question, but hey, I'm still going to ask it. Like, what is the legacy that you're looking to leave after you?
Yeah. So legacy for me is impact, right? I read a book by Vicki Robbins called Your Money or Your Life. And that's a personal finance book. It's all about frugality, saving. And the huge concept in that book I pulled away from it is that everything you earn money for, you're trading your life energy for. So when you're working a full-time job, you are putting X amount of your time into it to earn X amount of dollars, right? Everything in life is a trade of life energy. So because time is the most valuable asset, right? And she mentioned in that book that the most fulfilled people feel in life based on her data and her research and looking into other people's research as well is that when you drive impact to community or to someone's life, that's when you feel the happiest. Because at the end of the day, no one is going to remember that I had 20, 30, 40 properties when I die in my grave. That doesn't mean shit to a lot of people, right? But what people care about is what impact have you left in their life personally. So I mean, real estate is a means to an end for me. So I do enjoy real estate. I'm growing my portfolio, yes, but I'm still young. By the time I'm 20, maybe around 30 years old, I'm looking to transition into being a high school business teacher, which is definitely much less paying in real estate and even my current job right now. And the reason is because I feel like financial literacy and true business acumen, entrepreneurship is not taught in high school, or it's not taught to the amount that it should be, right? And as a result, you have these kids that are unfrugal, spending every dollar they make considering investing, not considering retiring, right? I want to instill to these kids is like, look, I've done really well in school. I've been where you're at. I've done well in school. I've worked great internships. I worked a full-time job, but I also done the entrepreneurship route. And I did all of these things to say that, like, even if you're going, it might not lead to happiness, because I was like really unhappy when I was still grinding at that full-time job, right? Like, and I just want to let them know, it's like, look, there are other paths out in life other than working the corporate route. Tell them about the importance of frugality, saving, long-term planning, letting them know that entrepreneurship is a feasible hobby if they take the right steps to it, right? And just opening their minds, because right now, a lot of the things that are taught are just very closed-minded. And that's how I look to drive impact to my community, right? By doing these things, right? Things that I never had for myself, and I have to learn for myself. And that's what I want to be remembered for, right? When I pass away, I want to be remembered for impact and the impact I had on some of these. Not, I know high school kids are also don't listen very much, but at least if I impact one every class, like that means the world to me, and that's what I want to be remembered by.
No, of course, the ripple effect. If you start with one, it will eventually expand. Yeah, but it's awesome. I love it that you want to leave an impact, on people, rather than, again, at the same time, you're looking to build your own portfolio and help the passive investors, who are going to be investing with you to earn, money, and which is a great way to be in. I mean, during these times, having another source of income, just like investing passively in real estate deals, is a great way to do so if you have available capital to do so. But the fact that you want to leave a legacy of impacting people, like providing them the right financial kind of mindset and literacy, it's an awesome thing, because of course there's a big gap in a educational system with that currently. So that is
Absolutely.
awesome. I love it. I love it. So it's been really cool to talk with you today, Austin. I mean, so many different creative strategies and tips, and it's been a tremendous amount of knowledge coming from you, even though you're 25 years old. But I mean, those 2 years, it seems like you put in a lot of effort, a lot of work, into educating yourself. Well, even though it was just a couple of videos and a book that kind of give you an entry point into real estate. But I mean, you did a lot. You did a lot, and you built a 20 unit, portfolio, in those couple of years, very fast, and it's been really cool. So, I wish you nothing, just the best of luck, and in everything what you do.
Oh, I really appreciate it. Thanks for having me on the podcast. Really.
Oh, that's no problem. Happy to. So listen, guys and girls who are watching this episode, as always, I just want to ask you one thing. If you share this episode with a friend of yours who is always talking about real estate investing but never pulls a trigger, this episode is definitely going to be a great for them, because, again, of those creative strategies, tips, tricks, inspiration at the same time. So I think it will give a good kind of starting point for those for your friend to start his own or her own personal real estate business. So again, Austin, I appreciate you joining me today. It's been a really great pleasure and fun talking with you today. And as always, I will see you on the next episode. Thanks for watching.